Hey there, okay, here's another one, and this one's the Bearish Breakaway. Now the Bearish Breakaway looks a little bit like the Bearish Three Line Strike. Now the Bearish Breakaway isn't a continuation pattern, it's actually a bearish signal. It's as it sounds. Okay, let's just show you what this one looks like. Alright, okay, so you're approaching an uptrend. Okay, now this is important. One candle needs to be quite big. Okay, and then the next ones, now there could be two more after it, there could be three more after it, there could be four more after it, there could be even five more after it. But what's important to look at is that these lines here are actually basically getting smaller or staying the same size, but they need to be smaller than this main candle here. And then the next thing we look at is the next bar that comes in, and this is all part of the formation. Alright, and then the next bar, this bear bar, okay, needs to actually close lower than the previous 2 days, and there's the previous 2 days right here. Alright, so that one works out well. So let's go ahead and show you some examples. I've actually found one, and it's right here. Alright, we've got a big push up here. It's got a little candle, but this one's got another candle that's almost the same size as that. But I'm not going to really be too worried about it, because the examples that you will see online, as I say before, are equity examples. Alright, equity chart examples. Forex is going to be a little bit different. Alright, so here is like another candle that looks basically the same as the first one of the formation, but this one, you know, it will do. I mean, this does actually confirm right here. I mean, it's a very small confirmation. It's not a great one. If it came down a little bit lower than that, the real body, if it closed a lot lower than that, there would have been a lot better. We should have seen an immediate push down. But this one, you know, didn't. Well, it took quite a while actually. It was quite a few days, you know, before it came down like 500 odd pips in 71 days. But what's also good to know is that this is on the daily time frame as well. And when that big push comes in, you can actually go in on the close of this bar and start the new one. It goes up against you like 116 pips, but it also comes down 150 or 160 pips. The very next day it comes down even more, down to 220. So you can choose to close out towards the day's end or halfway towards the day or wherever. I mean, 100 pips TP if that was what your target was. Then that would be fine. I mean, you can adopt different strategies with, you know, larger time frames. You could have one of these stress-free kind of trading environments where you're sitting there waiting patiently for the signals to come in, and then as soon as the signals come in, you've gone short on it. If you want to close out 100 pips for that day, that's fine. I mean, if you can do like 3 or 4 of those a day, and you're using good proper money management, and you're letting the money compound over the weeks and over the months ahead, I mean, I can't see any reason why a $10,000 balance wouldn't turn into $100,000 within a year. Alright, obviously you're going to need a little bit of practice before you get to that level. Okay, but for the most part, if you do your studies well, you know, you should be coming out a pretty good you know, advantage of most of the other people out there. I'm just trying to find some other examples to see if it's actually a strong, reliable one. It's not something, not kind of a strategy that I actually go for myself. I look for some stronger strategies like the 3 inside up, 3 outside down, and so forth. Okay, so okay, so this is a bearish breakaway reversal pattern. Okay, here's one. Now this is where you have to be a little bit again forgiving. We got a series of small candles here, and then it breaks and pulls away, right? But having saying that, that also looks like a bearish engulfing pattern as well. So, you know, the two kind of look like the same, but it depends on what's happened previously. Like, if I mean, we might have had, we can see that there's a series of up candles, and then there was a, well, just one huge one down. Okay, but if we had I mean, this looks like the formation that we're looking at, but it also looks like a bearish engulfing pattern as well, when you had this one little line there and then the next line that came down that engulfed it. But if we had a pattern that came from up and down like that, rather than a formation like here, which is what we're looking for, then this one would only be a bearish engulfing pattern, but this one here looks like a bearish engulfing pattern and also the bearish breakaway. Okay, so use your wits about you to sort of understand the differences between the two. Okay, and like here's another one. I mean, again, this looks like a bearish engulfing pattern, and in a sense it is, but it's also where the market has gone up and it just broke off and pulled away. Alright, the very next candle, the last one in the series is also very important. It closes lower than the previous 2 days. This is the previous day and then there's the one before it. So there you go. Alright, that is the bearish breakaway. Alright, so I'll see you very soon in the next video. Bye for now.